Okay, hello everybody. Welcome to Korean Atlanta Mentorship. In this video, we're just going to do another quick velocity banking review, and I've been making several videos about this. And the reason I'm making videos is because I think on the internet, people say very simplistic things like lines of credit good, loans bad, right? And each tool has its own use. Now, one of the things I want to emphasize is that velocity banking is not just simply replacing a loan with a line of credit. And there are going to be situations where that's actually going to not lead to a good situation, right? Because the whole goal is to maximize something called our cash flow using our lines of credit as our main operating account. But it does not mean, again, there's some nuances here, simply replacing any loan that we have with a line of credit. And here I have a spreadsheet that we always use. And again, let's just kind of start off with the basics. What is velocity banking? All velocity banking is a debt payoff strategy using lines of credit as your main tool or your main operating account. Now, I know there are some of you out there who have no idea what a line of credit is, and all line of credit is a financial tool where you can borrow money, pay back, and use it over and over again, right? If you have a credit card, that's a line of credit, but there's other types of lines of credit like personal, home equity. Now, I'm just going to do a quick demonstration before I go to bed tonight as to why we just simply cannot replace a loan like a mortgage with the line of credit, okay? So, in order to do velocity banking, we have to do two things. Number one is a budget. So, a budget is essentially our debt attack plan. If you don't have any debt, no need to do any velocity banking, right? It's a debt attack plan. And what you're going to do is list your income, your expenses, every single debt that you have. And what's really important is there's an order that we have to pay off your debt, right? So we have 10 credit cards and one mortgage, but let's take a look at this, right? In this scenario, the income is magically the same as the expenses, and there is zero savings and zero cash flow. Okay, but here's the thing that we have to emphasize is that we're going to be doing the opposite of what most Americans are going to do. Instead of increasing our savings, we're going to make sure that our savings is going to be for sure zero. Okay, so let's go ahead and keep this zero. And what I'm going to do is show you why we just simply cannot replace a mortgage with a line of credit. So let's just assume that we have a huge line of credit. I know this is somewhat unrealistic because if we got to try to get a huge line of credit at this point and we had zero savings and the banks looked at our debt to income ratio, they'd be like, yeah, right, we're not going to give you a line of credit here. But this is why it's important to understand how banks work, and banks only lend you money when you don't need it. Okay, so we probably, let's say we had a home equity line of credit lying around for it's almost like a $310,000 credit card. Okay, so the actual velocity banking strategy is your entire paycheck goes into that line of credit, expenses out, and then the underlying line of credit balance will go down by something we call our cash flow, which is our income minus our expenses. Now it seems very similar, the savings in our cash flow right now, but when we do velocity banking, our savings will always be zero, yet we can make this cash flow number increase. Okay, so what I'm going to do is show you why we should not, simply replace the mortgage with a line of credit. So we have a $300,000 mortgage here. So let's just assume that we move this into a line of credit. Okay, so we have a 10% line of credit, 6% mortgage, $300,000 balance. So what we do is decide, okay, I'm just going to replace the loan with the line of credit. Okay, and what happens when we replace the loan with the line of credit? This goes to zero. Okay, now let's take a look. Did I do this right? C2 minus C, whoopsie, C3, my bad. C3. Okay, so you might be thinking, oh my goodness, we went from 0 to 1700 without making more money. And yes, that's kind of correct, but it's kind of not. Because we also have to take into account the interest that the line of credit is going to charge us for using it as our main operating account, right? So this cash flow is a little bit deceptive in some ways, but for the most part, it will work out. It's just that it's going to be on a $300,000 balance, and so if we just do the math, right? So let's just go ahead and do the math. Let's see. And how do we calculate the next month's balance? It's the previous month's balance plus the previous month's interest minus our cash flow, which is 1798.65. Now you could see, oh, this balance went down, but every time you use a line of credit, the line of credit charges you interest based on the average daily balance, okay? Multiply it by the interest rate, 0.1, 10% divided by 12, okay? Now, if we go to the next month, look at that. We're actually negative cash flowing, right? We're negative cash flowing. Isn't that crazy? So like $600 here, right? So now it's 299, 3,000, and that's because, again, we paid off the mortgage first. We paid off the mortgage first instead of we paid off the mortgage last. Folks, this is why it's important that we just don't blindly just listen to what we hear on the internet and we actually do the math and try to do the numbers. Okay? So here, there's several reasons why you don't want to put the entire thing into a line of credit, right? And we talk about other things like chunking and all that, but the main thing I want to emphasize is that velocity banking is not replacing a loan with a line of credit. The line of credit is a tool to help you pay off that debt. And what we're going to do is increase this cash flow number to the max, right? It's like a calculus problem. If you ever taken calculus, they always ask you questions like, what is the maximum of this equation? Well, that's what we're trying to do with our cash flow number. And so this 1798, yeah, it looks impressive going from 0 to 1798. But when we're doing it on a $300,000 balance, again, there's these nuances we have to be taken account of. We're actually going to negative cash flow. This is worse for us than who knows what. And it's very similar to almost being in this situation, right? So let's do this, right? Instead of moving the entire mortgage into the line of credit, let's move these 10 credit cards, which is $167,000 of debt, okay? So let's go ahead and just do this and move just only, see, we moved $300,000 debt, but let's not do that. 167,000, okay? And then what we do is when we move this $167,000 of debt, let's see how much cash flow increases. 0,000,000,000,000,000. That's 10 credit cards. That's 10 credit cards. And now our cash flow is $5,345 minus the interest, right? So this is an interest that we can definitely sustain because the balance of that line of credit has a good enough proportion for us to be able to sustain that interest. Whereas when we moved that $300,000 mortgage into the line of credit, the interest was way too much because the balance is way too high, right? So now let's go ahead and put that number in. So 5345.83. And again, we went from zero savings to zero cash flow to still zero savings, but a cash flow of 5,345.83, right? So now let's go ahead and do this. And then as you can see here, that we just copy and paste, and then we're able to pay this off in about 37 months, right? 37 months. And what's 37 divided by 12? That's 3.808 years, okay? So a little bit over 3 years, 3.08 years. So I'll just put 37 months, okay? 37 months. And that's 167K of debt paid off in 37 months. And then once we have enough of this cash flow, we've maximized it and we paid off the debt, then we attack the mortgage. Now, why do we attack the mortgage last? Well, there's a concept called the cash flow index. So if you ever never heard of it, it's the statement balance divided by the monthly payment. And so think of it like this. If you, again, I'm not going to explain the whole thing, but think about this. Would you in your right mind ever pay $300,000 just to get $1,700 back? Like that seems like such a low return, right? Like you paid $300,000 back just to get $1,800 a month. Like a car loan is like, you pay $20,000 to get $400 back, which seems a lot more bang for your buck than $300 to get $300,000 to get $1,800 back, right? So because of the cash flow compared to the balance of the loan is so little, this is why we want to pay it off last. But the reason why we still want to pay it off early, so let me go to bankrate.com. Actually, let me do this. Loan amortization calculator.net. And then we just go in here and type in $300,000 at 30 years. Okay. Look at all this interest we're paying. So we borrowed $300,000 and we have to pay $647,000 in total because the interest is actually more than the balance of the loan, right? It's like we're paying 200% interest. Isn't that crazy? Well, not 200%, 100% interest, right? A little bit more because this is actually more than the loan, right? So again, yes, we need to pay it off, but we need to be a little bit patient because what we need is an immediate return, bang for a buck, to maximize this cash flow number. And we're not going to do that by simply replacing our mortgage with the line of credit. In fact, replacing, especially in this example, we're making good money. Attacking the mortgage first is a giant mistake because we were actually technically negative cash flowing, right? And then once we paid off, maximize this cash flow number and paid off the debts associated with these credit cards, then we go ahead and attack the mortgage, right? And it doesn't matter which way you attack it. You could use a line of credit to attack it. You could use extra payments. Now, here's a comment that I'm going to make. Extra payments is the default option. So why do banks know that you're likely to refinance in 5 to 7 years? Is because they know that nobody puts their extra cash flow directly into a loan. So one of the things that you could do is just move parts of the principal to the line of credit and then put your entire paycheck there and rinse and repeat the process, right? I've shown this many, many times, but to be honest, I'm getting a little bit sleepy right now. And if you really want to see, I'll make another video because I've made over 400 something videos, I think, about this topic, or possibly 200 at least. All right. Well, yes. So this is just another video to warn you that not to engage in simplistic thinking that velocity banking is replacing a loan with a line of credit or loans bad, lines of credit good. Each one has their uses, but here's what I know about loans. They disincentivize you from making extra payments to that loan because it's a one-way street. So kind of get the best of both worlds by using both lines of credit and loans, right? And we do eventually want to pay off the loan. It's just we got to pay it off last because if we pay it off first or transfer into a line of credit, we're actually going to go into native cash flow. Whereas if we do it the right way in velocity banking, there's a component or philosophy of paying off debts the correct order. We want to increase this cash flow number as much as possible, as soon as possible. Okay. All right. Well, this is Korean Atlanta Mentorship. Believe it or not, so it's already 1:46 a.m. and I should go to sleep. Well, have a great day, everybody, and we will speak next time.